Hi, everyone, and welcome to this week's installment of Mish's Market Minute. I am your host, Michelle Schneider, and it's been one heck of a week, finally seeing the market dive for lots of different reasons that we will cover. What we plan to do today is have a look at all of the indices, the key sectors, some of the outliers, and we're calling this segment, What Does Stagflation Look Like? Because we've heard the term, I've used the term, many other economists now are using the term, but we are traders, so we want to know exactly how do you trade in a stagflation environment, and that's what I hope to cover with you today.
So this is going to be the list of symbols that we're going to cover. It'll be pretty broad, and hopefully we'll get an idea of how to navigate this market without a lot of the hysterics that you're going to hear from the talking heads. So let's go to the charts. So we're going to start with the Qs. Now, if you look at this chart here, we actually are looking at a weekly chart. Okay, now this weekly chart, I'm going to actually make one adjustment to it here. Because if I put the underscore in, sometimes the moving averages change. But I want to stick with the weekly charts for now because we're looking at perspective. And in the perspective of this, first of all, in the Qs, even though people are talking about this major crash landing, if you take a look at it right now, it's just touching the 50-week moving average. Does that mean that this is the buy opportunity of the century? No, but it does mean that at least these big calls for major crashes may be a little bit premature, in that even if we break down under this 358, what I've been looking at is these range bounds. And right now, if you take a look at the Qs going back just in this time period, which was in October, we saw a low of 350. Maybe that was in October. It's hard for me to tell. Hold on. Yeah, it was October. You see the date on the bottom there. Sorry, I didn't see that. October 4th, that week, we tested a low of 350. And if you go back in time, even beyond that, we go back to July, that low was about 352. And if we go back a little further into June of 2021, that low is 350. So when I'm talking about stagflation, what you have to understand is that from 1969 to 1982, the Dow Jones Industrial literally went sideways. And so what that did was make it very difficult for people to make money in equities market unless you really kind of switched your mindset to how you trade. And that's really what I want to talk about with you today, because in this type of environment, you can buy these support levels, but you have to be extremely nimble in your ability to get out of them quickly. And if you don't want to do that, then there are other instruments that you could be looking at, or considering we're also in the earnings season, you can look for things that are outperformance. The point is that outperforming. The point is that this is going to require not only some kind of a vision of what could happen in a stagflation environment, but also going to require perhaps a little bit more of an active trading type of mindset when you're looking at the markets. So now that's the Qs. Let's take a look here at the SPY. And the whole point of me doing this with you today is I really don't want you to feel like these calls for a 20% move lower should scare you. I'm not saying that you should have passive buy and hold type investing, but what I am saying is that there will be some opportunity in here. Right now with SPY, we're not even down to our 50-week moving average. And again, right underneath that, if we go back to the same period of time, let's say in June, we're looking here, this is July. So if we go back to June, the June lows here were at 414. This low here was at 426. And right now, so far, the low this week is 440. So if we take a look at momentum, obviously we can see that the momentum has come off, and we can't look at leadership, obviously, because this is SPY with SPY. But nonetheless, what we can see is that even if we break this 50-week moving average, we still are in bullish phases, hanging on for dear life into the NASDAQ, but also with the SPY still very much on a weekly bullish phase. So there's a difference between a weekly chart and a daily chart. And in the daily chart, you can see here that the difference is we've broken through the 50-day and we're holding on to the 200-day, but you can also see those ranges I'm talking about much clearer. Now, we don't know exactly where the range is going to settle. It could be that today was the low, but there are a lot of geopolitical influences in the market right now. And overall, besides the Fed, besides earnings like Netflix that came in horribly, besides the fact that there is talk about what's going to happen with Russia, Ukraine, the administration basically making comments that the market didn't like. There's even problems still going on in Yemen. You know, we don't really know, but what we do know is if we keep our eyes on the ball, this is the type of thing where if it holds the 200-week, and next week we come in and see that we still have some support and we start to move up, say, to the low or beyond the low of what we saw on Thursday, then you can say, or through a Bollinger Band or what have you. Remember, mean reversion is going to be a big thing this year. We're not nowhere near a mean reversion in the momentum, but we are potentially in price. Then you at least can get some good active trades that sometimes can turn into longer. It all depends on market conditions, of course. If we go to IWM, now IWM actually broke through this. Let's go to the weekly chart on this one. This one actually broke through that range that we were talking about from February at 204, and today it went down to like 199. But that doesn't necessarily mean that we can't go right back into that trend and into that range, because remember, we did that here with the highs. We broke out of the range on the high and then came right back under. So we can break down from the range on the lows and then go right back into it. And that is stagflation. It's like the market is going to stagnate. Particularly what makes it interesting is that the yields have aptly come down. The Fed has certainly looked like they're not really that interested in controlling inflation right now, because they've got much bigger fish to fry. And that's really essentially what we're talking about here. That also means that the hyper part of the inflation still hasn't been seen. Some of the statistics are showing that inflation is really basically waned, and I don't believe that's true. But nonetheless, we are seeing some interesting things in terms of oil. We'll take a look at the grains in a moment and all of that, gold and silver. But right now, what I'm saying is that do not think that we're in for a big crash. At this point now, I think we're just going to be establishing this range. The worst thing would be choppy within the range. The best thing would be to buy on the support of the range, have a much tighter stop and a much tighter profit target, and become much more of an active type trader in this environment. The last one, of course, we're going to look at is diamonds. Again, the weekly chart. So now what are we seeing here? We're seeing three of the charts have their positioning on the 50-week moving average. And so at this point now, diamonds, SPYs, and even the NASDAQ not looking too bad. So I'm not saying that they can't break these 50 weeks and then we go more into a negative bear market. That's certainly possible. But I'm saying for right now, don't necessarily predict that to happen until it does happen, and just maybe for the next couple of days, keep the powder dry to see the direction of the price. Now let's move on to some of these sectors. Whoops. Let's go to semiconductors, because that's another one. And that's why I really think these weekly charts are so important. Again, this broke down, but this has not gone down below the 50-week. So what does that tell me? So that not only is semiconductor still in a bullish phase, just come off of the highs, but that also we've got a situation here where some of the chip stocks might be interesting. So like, for example, if you look at the board just on the day I'm talking to you, IBM is green, Intel is green. Microsoft is barely down. NVIDIA is down, but that's been sort of coming off for a while now. So you have to kind of look around and see. If you look at American Micro Devices, that's basically unchanged. So these are the kinds of things that you would go to potentially to look. Apple, which I wasn't planning to show you, but let's take a look at Apple, because that's been the quintessential bull. And Apple right now, I don't know what this is right here. This is very strange. Let me look at Apple differently. That's better. Okay, so with the Apple chart, we're never even close to the 50-week moving average, and we're not even that far from all-time highs. Now, what's interesting is we never got a mean reversion sell signal here. Obviously, this is still well outperforming the SPY. So this would be another one to keep an eye on if things calm down. That's a real interesting chart to me. And let's just take a look at the daily. We're under the 50-day moving average on the daily chart, but it's also possible that if we can get back over, say, this 168.50, you've got really down to 160 now. Or if we get closer to 160, then that might be another area too. But really basically between 160 and 169, we're going to establish a range to see if this can actually get back up. And by the way, I do want to mention that with Apple, you have earnings. Now let's go to what I think is one of the most important sectors to keep an eye on, and that's the transportation sector. Now let's go back to the weekly on this one. Now this is actually breaking down a little bit on the weekly, but the day is young, which means that it hasn't actually fully broken down yet on the weekly. If this holds the 50-week moving average, which is roughly at about 260, then I think that I would definitely be more cautious about getting too negative, but that doesn't necessarily mean we could get all positive. It just really kind of proves my point that we do have somewhat of a range-bound market, and the market may be stretching to try to find its ultimate range, but nonetheless, that looks like the ultimate range is inevitable. And that's kind of what I'm talking about here. It requires a different mindset this year for trading the market. Now, with IYT, you had a couple of earnings that were good. Union Pacific is actually looking good as I'm talking to you. CSX, I don't think as much, but Union Pacific, you want to be looking at FedEx. Those earnings haven't come out yet. So these are the kinds of things that you want to keep your eye on if this can actually sort of hold up here. Now, as I'm talking to you, let's take a look at the next sector, which is KRE. Now, of course, we had many bank reports. And again, look at KRE, obviously still above the 50-week moving average, still in a bullish phase. Big bar down, though, from the high, especially since we sort of had a split on the earnings. JP Morgan got killed, Morgan Stanley got hit, but yet rallied. Wells Fargo seems to be holding relatively steady of the banks. That's still in a bullish phase. But if you look at just the actual KRE itself, if this can hold up here around the 72 level, that also, if the market stabilizes, could be an opportunity. And so I would be looking at that too. Anywhere between 70 and 72 really should be the support. Of course, if it breaks, then we're going back to looking at the range-bound support from 2021, which was really down more around 60. And the next sector we're going to look at is IBB. Now, IBB Biotech has been weak. And you can see here that not only has this broken, I'm just going to change this to a regular symbol here without the underscore. Yeah. If you can see here that this looks like a 200-week moving average has been tested at 127.71. Now, this would be a really good one. We talked about this before, to watch for a potential mean reversion. So basically, what does a mean reversion mean? What it means is that you get to an extreme high or an extreme low, and eventually what happens with the momentum, which is why we have the real motion indicator here, is that if the momentum breaks down under the Bollinger Band and comes back through it, and the price breaks down under the Bollinger Band and comes back through it, then you're going to get back to some normalization of the price of this particular instrument or any particular instrument. Now, that hasn't happened yet, but what intrigues me about this chart, of course, is that we are corrected now to a point where we're testing a major moving average, being the weekly moving average on the 200-week. So keep that 127.71 in mind. The next one is retail sales, dismal. Here's XRT. Now, this did actually break down under the 50-week, but let's go back to that trading range theory. If we go back to this low that was made here in February of 2021, similar to IWM, although IWM is a little bit lower because that was at 204, this has not actually taken that out yet. So that means that at around 74, we could find some support. So even if IWM breaks down under its low, this is why we actually like to look at the whole modern family. If IYT maintains and XRT can actually hold these levels, then it tells you that eventually IWM will either play catch up or that IWM is leading and that the others will start to fail. We really can't tell that right now, right at this point on a Friday after a volatile week, but we can certainly know what to look for as we go into next week. Okay, and that really basically is the entire economic modern family plus the indices that we need to look at. Now let's look at another type of index, and that is emerging markets. Because emerging markets, some of them have actually been outperforming. Now, if we look at the overall space of EM, we can see that right now it's under the 50-week moving average, and here's your 200-week. And also, if we go back to that same time period, we broke down briefly under that trading range, and now we're back above it. So remember, I told you, you can actually break below a trading range like you can break above it. Well, actually, if we go back here, it's not even that bad. But right now, you can see here, if we go back to this low right here, which is back in November of 2020, then we kind of are holding around those levels right here. Let's really compare it more to what we were looking at, which was the February low. So we have to go kind of like all the way here. And this thing has definitely broken down. However, in the mean reversion world, this actually had a mean reversion trade because it broke down under the Bollinger Band on the momentum. See here, broke down under the Bollinger Band on price, closed above it, tested it again, and now we're back over the 200 on momentum. We never broke it on the price, obviously. And so if we can actually get a move back up over 48.56 in this emerging markets, well, actually, it is above that right now. I'm sorry. I looked at the wrong high. 50.89, excuse me. If we can look at 50.89 as an interesting place, which would be about $1.50 from where we're currently trading, then I still like some of these emerging markets. We were in Mexico, we're out now. I'm still looking at China, I'm still looking at Greece. Brazil is actually up on the day, South Africa is up on the day. So emerging markets, particularly tied to the dollar, will be an interesting thing to keep an eye on. I just wanted to mention that because I still think that we can see emerging markets do actually a little bit better. Now, if we take a look here, move on at some of the outliers, let's go to junk bonds because this is also super interesting to me. Some of these charts, when you put the underscore, they get messed up. This is more accurate. So this is a weekly chart on high grade debt, high grade yield, junk bonds. Now, look at this. This actually is sitting on the 50-week, just sitting right there. But this didn't even break the November 21 lows yet at 106. This is really why I thought that the market may not necessarily be so ready to crash, is that in this particular situation right here, we've got where if we hold 106, it means there's still some interest here in some of these junk companies. It's also showing a little bit of leadership over the SPY, even though the momentum is not great. Now, again, I never advocate necessarily trading this. It's just really, really good for information. And now moving on, the other thing that we must look at, of course, is TLTs, and that's the long bonds. Now, TLTs are still underperforming the SPY. That's good. But it looks like it could challenge it. Obviously, momentum's not great, but on the weekly chart, this held the 200-week moving average. And that's why we're seeing the yields a little bit lower. And we're seeing here a bit of a bounce here on the chart off of this 200-week moving average. So when I talk about range-bound trading, this is a classic example because after it looked like it was going to hold this 140 level, if you would have gotten in on the basis of even the mean, well, it didn't quite have a mean reversion, but even if you got in just on the basis of this week, once it got back over 141 with a tight stop, This is the kind of thing where if it gets closer to the 50-week moving average, you trade for a few dollars. You just have to make sure your risk reward is there. And when I say risk reward, I'm talking about kind of a 2-to-1 type of risk reward here. So if you're going to risk $1 and you can make 2, why not? Just means adjusting your mindset. Now let's go to UUP, because the dollar is going to be a big factor in this in terms of just overall inflation. In this particular chart right now, you could see it's still in obviously an accumulation phase, not a bullish phase, because in a bullish phase, the 50 would be above the 200. So the dollar is still not necessarily weak, although it did come off from the high. Now, I like to look at DXY, and DXY is actually more in a warning phase on the daily chart. And if I look at DXY on the weekly chart, it's very similar to this UUP. Having an inside week so far, by the way, which is also interesting. So one of the key factors to look at for this is if this breaks back down under that 200 week, and particularly if we break that back down under this 25-35 level, then it's possible we'll get another whoosh down, maybe closer to the 50-week moving average. If it holds here and starts taking out these highs from last week or 25.78, then the dollar continues to be strong, and perhaps that does not only put a little bit of a kibosh on some of these rallies we've seen in the metals, but also puts a little bit of a kibosh in the whole idea of the Fed having to so aggressively raise the rates, because they're going to be a little bit hesitant to do that in this type of environment right now. The next thing to look at here, of course, would be the sort of the sister of it, which is FXE. Now, FXE is very hard to trade because it's a very thin instrument, but nonetheless, that's been in a negative phase. This is in a distribution phase, actually, on the weekly chart, because the 50 still hasn't crossed below the 200. But nonetheless, this had a perfect kind of mean reversion type of situation here when it finally crossed the momentum. So right now, you want to say 105 is your key. Would I get interested in this? Well, obviously, I would say we need some work to do on this. At the very least, we'd have to get through this high here of around 101, excuse me, that's not 101, 106.69, 107. And then maybe we would have an interesting opportunity here to be looking at the euro, and that would certainly correspond well. Now let's take a look at VIX. One of the things that have been a factor is volatility has been very, very low. And I'm going to change this chart too. I don't like the way this chart looks. That's better. You could see that VIX volatility has been down for a long time. So now what's happened is we got this pop in volatility over the last couple of days, and we got right into the resistance here at the Bollinger Band on this particular Bollinger Band. So really, the other factor of a range-bound market is that we're actually seeing volatility increase a little bit, but certainly not to a point where it's dramatic. And actually, as I'm talking to you, IWM just went green. So remember, I was telling you, range bound doesn't necessarily mean if it breaks the range, all bets are off. It could break the range for a couple of days and come right back into it. You've got to be careful in this market of looking at these long trends. Long trends may be over, although as we saw, there's still a lot of bullish trends going on in the economic modern family and in the Qs. So watch your volatility. Maybe if we can close above, let's say, where these highs are today, which is at 22.68. Wow, it really got up that high. Then perhaps we've gone to something and we'll see a move closer to 32. But I'm really trying to show you that in a stagflation environment, this is what happens. People get very, very wound up, and they wind up getting killed on the long side, and they wind up getting killed on the short side. Which now leads me to gold. If we're really going into some kind of a hyperinflation or super cycle inflation, which I still believe, gold, a couple of things about gold that are interesting. One is that it actually looks like it's decoupling a little bit from Bitcoin. Number two is that if you look at, it's outperforming the SPY. That's very interesting. If you look at the momentum, it was doing better. Momentum hasn't really got going yet. So we're over the 50 on this one. And as being over the 50 on this one, right now you want to see it hold around this 167.84 level. And you also by the way, didn't actually have a mean reversion here on momentum at all. You just had it on price. But if we can get back over this 174, 175 level in gold, and particularly volume comes in, that could be a very interesting play this year. And the same thing with silver. Silver right now did exactly what silver does. On the weekly chart, it went right up to the 50-week moving average, and it came off a little bit, not by much. So now, again, outperforming the SPY on the weekly basis, and momentum looking pretty good here on a weekly basis. Let's take a look at this one on a daily chart, actually. And on the daily chart, you can see the momentum is actually much better here. You kind of want to see it hold this green line because you don't want it to get into an extreme high situation against the 200-day moving average. But nonetheless, right now, I would imagine that 22 or anywhere from 2178 to 22 should hold. And if we can get through that 200-week moving average, what we have is tremendous bottoming action here on this daily chart. Looks like silver can also go much higher. And I've been writing about that, and it's in my report. Also, with oil, so here's your weekly, here's your daily chart in oil. But oil obviously come off a little bit from the highs, never quite got there in the momentum on the daily. So that is another one that right now 60 looks like it's got to be good support. So even oil prices are going up, even though the actual been an increase in inventory, it's actually showing here still some real strength. And here's your weekly chart on this. Actually, let's do the weekly chart without the underscore. And you can see the weekly chart here also very interesting. Potential Bollinger Band mean reversion to the sell side possible, but we'll see what happens here as this goes forward. Interesting, though, that after all of this, we still haven't filled this gap that goes back to 2020 in March. That would mean we could still see a move up here to around 68. And that's kind of what I think could happen here. Now, DBA is holding 20, and it couldn't get through the resistance here on the Bollinger Band. Your momentum has been great here as well, outperforming the SPY. But meanwhile, as I'm talking to you, grains are kind of wishy-washy. You know, we're in the summer season in some of the growing seasons, and we're in the winter season, obviously, here in the United States. Corn is up here, but this is also going to follow the softs like coffee and sugar, and they've actually come off from the highs. So DBA itself is interesting here. I think if it can hold 20, let's take a look at the daily chart on this one. If it can hold 20, you see here, you're really seeing, well, you're not really seeing a mean reversion, just more on price. But if it can hold the 20, it looks good. If it starts to break down on that 20, then maybe the grains get a reprieve. And then two more to go is XLP. So this is actually consumer staples, which has been chopping around. Let's take a look at this one on a weekly chart. On the weekly chart, though, we're still in a big, strong trend, and all we're doing basically is developing another flag. And look at how well this is outperforming. So this would be another one to keep an eye on. I think next time this gets through 77.20, this thing could fly up. And it's another reflection of a stagflation where people will then consume what they need and not necessarily what they don't need, which is why we're seeing the big stock difference. And of course, utilities is another safety play. And utilities also have come off from the high. And this is the weekly chart, but still well outperforming the SPY. And if we take a look at the daily chart, getting a nice bounce off that 50-day moving average. So if we just put this all together, essentially what I'm saying is try not to buy into the hype of a major crash. Really be aware of the ranges, and the ranges going back further left on the chart, not just what you see recently. Watch those 50-week moving averages, particularly in those key sectors that are still bullish and in the indices. And when those 50-week, or if those 50-week moving averages break, then we can start talking about a deeper and steeper correction. But at this point right now, like I said, think more shallow in terms of your trading and wait for some kind of a trend to emerge, and be prepared for the fact that we may be relatively stagnating and trendless for a while. And that brings a whole new host of types of trading.
Okay, guys, hope that you have a good weekend, a restful weekend, and get ready for the increased volatility that we have coming upon us next week. Thanks so much for watching, and bye for now.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.